Chief Investment Officer at Portfolio Wealth Advisors. I love when you're in studio, Lee. It gives us a chance to discuss everything that's going on. First of all, we had a big sell-off, right? The market turned around on the ISM number this morning. So manufacturing data was really surprised everybody. It was a big miss and the worst in 10 years. So you have the Fed waiting at the end of the month. What are you thinking?
I don't think we're going to be as volatile as people think we're going to be. I mean, look at today. We get the numbers from the ISM. Not good. Now, I could say all I want that this is the trade war overhang, but the trade war is real. We're going to have to live with this for a long time.
Right.
But considering we've got a complete blow up with John Williams over at the New York Fed, right? Now we know when they make jokes when that guy came on saying he couldn't run a Bloomberg, what's the worst that can happen? We're starting to find that out with the cash crunch. We've also got bad manufacturing numbers, but there's $3.4 trillion in cash money market funds. I think retail investors are very underweighted in equities, and that's why the market's not down more today, and that's why I think we're going to have a non-volatile upward sloping market for the rest of the year, because when everybody is thinking there's going to be a 10 or 15% correction, there ain't going to be.
Right. So it's climbing the wall of worry.
I think so.
And the other thing is people want to keep their money in the market. They don't want to leave it, under the mattress. I mean, they can't leave it in the bank. They make nothing.
Right.
So they are looking for great picks and places to invest. The talk is that the Fed will cut.
Oh, yes.
And that the Fed will talk about quantitative easing in a very transparent way. Here's what we are going to do, and this is how we're going to do it.
Yeah.
Do you think that's probably what we're going to hear?
I think that the idea that the Fed is going to be clear, I think is I'm skeptical of that. Are they going to cut? Yes. They're already doing quantitative easing by virtue of these repo markets.
Right, which they won't call, but that's sort of willy-nilly at their just when they felt like it.
Yeah.
So if, obviously they've been doing that to bring that liquidity, but the truth is that when they have these meetings on October 30th, that should be more clear. Here's what we're going to be buying in this amount each quarter, whatever, right?
And I do think that that's what's going to happen, but the Fed's got to cut at least another few times just to keep the ball rolling.
Few times?
Well, I think we're going to see 2 cuts over the next, say, few meetings. I think we have another 50 basis points in there because if they don't back up the housing markets right now and they don't continue on with this positive feedback loop by which average retail investors out there in Main Street USA are able to refi their homes. Right. We're talking about 5-10% cash flow into people's pockets. It's going to be a problem because I think that we're too rosy on projections for next year. It was just like beginning of this year. I said second half, of 2019 isn't going to be great, but we've lowered expectations.
Right.
So I think when you're committing money, you have to think about what has the lowest valuations and what has the most probability of doing well going forward. And that's not always tech.
I noticed that you liked gold. Now, gold had run up. It came off of those highs. It was rebounding a little bit after touching the lowest level since August, but it had been running up. But so you like gold, right?
I do. And, as soon as I bought a little gold, I haven't bought gold in 10 years. And I did last month. And I sent an email to all my clients and said, I have not lost my mind. I'm not turning into an angry guy yelling at the TV set, reading gold newsletters. It's simply, let me give you a little trade talk. I run more balanced portfolios where I have stocks and bonds in them of my intermediate bonds for my clients, right? I sold 20% of those, just took them all off the table and started buying gold because I don't think over the next year you're going to see the type of 20% upside you're seeing in long-dated treasuries. And I think that it's just a matter of time as these negative rates around the world keep going lower. You're going to have a lot of international investors who are going to have their fill of buying 10-year treasuries at 1.7, 1.5. And gold now has a cheaper cost of carry. It's cheaper to hold gold, which pays no dividend in cash flow, than it is to buy most sovereign government debt outside the U.S.
So you think there's going to be a lot of foreign investment, and that'll help keep gold afloat and move it higher?
Yeah, and it's a great hedge against what may not occur over the next year. So I think that when you're looking at the choice between should I be running into this bond bubble, I'd say I'd rather have a little gold because it doesn't cost me as much to carry it anymore. ETFs are very cheap. That IU is very low to hold it, and we'll see what happens. But that's a fixed income substitute.
Financials?
That's what drives small cap value. If you look at small cap value indexes, 25%, give or take, is in the financial sector. It's the most speed up. That's
so
what
you like the financials, like the big money center banks and small caps.
Yes.
Right? Okay.
And the reason is that, at some point they get beat up. You start getting these cuts.
Right.
And it's going to start getting that yield curve a little bit better and allowing banks a little bit more of a profit margin.
Do you worry about an inverted yield curve like today when we see the yields pulling back?
Well, a year from now I do. But listen, every time we get an inverted yield curve, last 7 times since World War II, it takes 18 months for problems to happen.
Right.
That puts us later next year. So I'm a believer of the yield curve. I think it's a sign of recession 18 months later. So we had that happen this summer. I think you got 6 months of clear sailing. I think you have to buy every dip. If you want to buy tech, go for it. It's not my thing. But I think now is the time. You saw September, this historic transition from growth stocks to cheaper value stocks. I think you can buy anything. January 1st, I may come here and tell a more bearish theme for the 2020.
Why do you think 2020 is not going to be as good?
Well, eventually we're going to have a problem. And we're going to have a problem where the quality of earnings, right? I mean, profits really peaked a few years back.
Okay.
But we've got earnings and revenues growing, and it distorts the profit picture because there have been so many buybacks. As long as the Fed cuts rates and juices the system, there's nothing
That's
wrong
what a lot
with
of people have said. They're concerned about all the buybacks. What about EFV, the year value?
Oh, I love this. I mean, you're talking about a 4% dividend yield with, maybe about 1.2, 1.3 book value. So think about a European investor right now. They can either pay 0.5% to keep their money with the government, or they can buy stuff damn near book value with a 4% dividend yield.
Yeah.
And they're not. I want to be first. Not a single person will say a single nice thing about European equities except for Lee Munson, and that's because bull markets are born in pessimism. And this is just like summer of 2009 when the S&P was yielding 4%, and people like George Soros said, "We'll never recover." That's all I hear now 10 years later in Europe, because you buy when there's not a single sign of life.
Right.
And that's where Europe is right now. And I think if you buy the cheapest bit of it, I think you're going to make money. And I think you're going to make money over the next 3 to 5 years because we're priced for no Brexit. We're priced for everything goes bad. Even Italian banks are becoming less horrific.
Oh my goodness, it's so funny. What is the number one question that all your clients are asking you these days?
Oh my God, when is the recession going to come? And what are you going to do about it? And I've explained to them very simply, for the next 6 months, we act as bulls and we buy every dip with reckless abandon. And then we start scaling slowly to an underweight in equity position, focused on the cheapest, trashiest things in the market called value stocks, and wait for the fireworks to happen later next year. And if I'm wrong, so what? We're underweight a little bit. But I think you have to pick up those dividends in Europe. You have to buy what's left for dead, and that's how we're going to make money. But I think that the idea of anything really being a concern for 6 months, that's not the issue. Again, the yield curve would suggest later at the end of next year. We also have a big election, I've heard, and
Believe so.
And the trade war is real. It's not going to go away.
All right, Lee Munson, excellent. Thank you for being on with us. I love that last response, too, about what everybody's asking about. Lee Munson, Chief Investment Officer at Portfolio Wealth Advisors.